What if I told you that one of the most heavily traded tech funds in the entire world, like a fund whose whole identity is tied to tracking behemoths like Apple, Microsoft, NVIDIA, doesn't actually own a single share of those companies?
It is wild when you actually think about it.
Right. I mean, you look at your portfolio app, you see a ticker symbol that looks incredibly familiar, and you just assume, hey, I'm buying a slice of the American tech sector.
Yeah, that's exactly what they want you to think.
But, under the hood, there's literally no stock. It's just this massive, incredibly complex web of debt and contracts that can and has evaporated 70% of your money
Oh, yeah.
in a matter of days.
And that invisible machinery, that's exactly why we need to talk about the dangers hiding in plain sight on these modern brokerage apps.
Welcome to this deep dive. You sent us a fascinating article today, and our mission is to, well, decode the Qs. Specifically, we're looking at two financial instruments, QQQ and TQQQ.
Separated by just a single letter.
Exactly. One letter, but they operate like entirely different species.
Oh.
Okay, let's unpack this. I really want to get past all the financial jargon and hit that aha moment about how these products actually work.
Because confusing them, it could genuinely obliterate a retirement account. I mean, we're living in an era where retail investing is more accessible than at any point in human history,
Oh, for sure. You just pull a supercomputer out of your pocket and tap a button.
Right. You tap a button to buy standard index funds or crypto or highly leveraged derivatives, but the architecture of these apps displays these products right side by side.
Making a totally foundational long-term wealth builder look identical to a highly volatile trading tool.
Exactly. So to really grasp the risk of that single letter difference, we first have to, understand the baseline. Both of these funds are tethered to the exact same engine, which is the Nasdaq-100 Index.
And the Nasdaq-100, that goes back to what, 1985?
Yeah, 1985. And it was created with a very specific, almost aggressive mandate. It tracks the 100 largest non-financial firms listed on the Nasdaq exchange.
Okay, wait, that non-financial rule feels like a really major differentiator.
Oh, it's huge.
Because it intentionally weeds out all the massive Wall Street banks and investment firms that usually, dominate those broader market indexes.
Yeah, it fundamentally changes the character of the index. By excluding the financials, you're historically left with this incredible concentration of technology, telecommunications, and biotech companies.
But they don't just let any tech company in, do they?
No, the barrier to entry is notoriously strict. A company has to maintain an average daily trading volume of at least $5 million for 3 consecutive months, just to even be considered.
Wow, $5 million a day.
Right. And then the index goes through this rigorous quarterly rebalancing, plus a massive annual reconstitution every December.
So they're just constantly churning the bottom.
Exactly. Companies that lose their dominance are ruthlessly cut and rising stars are added, so it's a highly curated, momentum-driven list.
And because it's market capitalization weighted, I mean, that momentum is completely top-heavy. The way I like to picture it, it's like a tug-of-war where the biggest players on the rope, your Apples, your Microsofts, are pulling with the strength of 50 people.
That's a great way to look at it.
Yeah, and the smaller companies at the bottom of that top 100 are basically just, hanging on to the rope for the ride. If Microsoft and Apple decide to run forward, the whole index just gets dragged with them.
Yeah, and taking that tug-of-war analogy a step further, those few massive players don't just dictate the direction, they dictate the velocity.
Because they're just so massive.
Right. Tech firms have historically made up more than half of the entire weight of the Nasdaq 100. So with that concentration of mega-cap growth stocks, you just get an inherently more volatile ride than you would with, say, the S&P 500.
Which brings us to QQQ, which traders affectionately call the cubes. This is the Invesco QQQ Trust, and the stats from the source material are honestly just staggering.
They really are.
By the mid-2020s, this single fund was managing nearly $300 billion. We're talking about an average daily trading volume of over 30 million shares. It's so liquid.
It's incredibly liquid. And a big part of that appeal is the cost, It has an expense ratio of just 0.20%.
Which, just as a quick refresher for anyone rusty on expense ratios, that just means for every $10,000 you invest, the fund managers only take $20 a year to run it.
Right, which is nothing. It is the definition of a core holding for investors who want aggressive growth.
Yeah.
When you buy regular QQQ, you are actually buying the company's pulling the rope.
Right, you own the fractional shares.
Exactly. You own fractional shares of NVIDIA, Amazon, Meta, Alphabet. And while it's heavily skewed toward tech, you do actually get a sliver of diversification in there.
Like what?
Well, you get exposure to consumer discretionary companies like Costco alongside healthcare and communication services. So it provides a relatively stable, unleveraged way to capture that tech momentum.
Though reading through the fine print in the sources, I did notice something kind of quirky. QQQ is actually structured as a trust, a unit investment trust, specifically, rather than like a modern open-end ETF.
Yeah, that's a legacy thing.
Right. The article points out that because it's one of the oldest exchange-traded products out there, this trust structure creates a little bit of a drag. Like they can't instantly reinvest dividends the way modern ETFs do.
Right, which creates a tiny cash drag on the performance.
Yeah, it's a small con, but an interesting quirk. But overall, it's a straightforward buy and hold asset.
Definitely. If you believe technology and large cap growth will continue to expand over the next decade, QQQ is a highly efficient vehicle. You buy it, hold it, and let the long-term compounding do the heavy lifting.
But okay, here's where it gets really interesting. What if you don't want to wait a decade?
Enter the TQQQ.
Exactly. The source introduces us to the ProShares Ultra Pro QQQ, trading under TQQQ. And this fund has one specific super aggressive goal: to deliver 3 times the daily performance of the Nasdaq-100.
Right. So if the index goes up 1% today, TQQQ goes up 3%. It is basically the adrenaline shot of the ETF world.
Okay, I'm going to play the eager, slightly naive investor here for a second, because the second I read triple returns, my brain went to a very specific place.
I bet it did.
We know the Nasdaq goes up over the long term, right? Tech is a powerhouse. So why wouldn't I just take my entire 401k, dump it all into TQQQ, get 3 times the stock market's return every single year, and just retire 20 years early?
I mean, it sounds like an infinite money glitch, right?
Exactly. Why isn't everyone doing this?
Well, what's fascinating here is that the logic you just laid out is the exact psychological trap that catches countless retail investors.
Oh boy.
It sounds foolproof when you zoom out and look at a 10-year chart, but the critical flaw in the strategy, the thing that will completely dismantle your portfolio, lies in 2 words in the fund's prospectus: daily returns.
The daily returns, not annual.
Exactly. TQQQ aims to triple the daily return of the index, not the annual return.
And that daily reset completely changes the math, doesn't it?
It changes everything through a mechanism called volatility drag. Let's actually run the numbers to see how this destroys capital.
Okay, let's do it.
Imagine the Nasdaq-100 is at a value of 100. On Monday, the market gets spooked and the index drops 10%. So it's now sitting at 90.
Ouch, but, a standard market correction.
Right. Now, on Tuesday, the market rebounds. To get from 90 back to 100, the index needs to go up about 11.1%.
Okay.
So Monday it drops 10%, Tuesday it rises 11.1%. The index is perfectly flat. It is back exactly where it started at 100.
Got it. I follow the baseline.
Yeah.
So what happens to the guy holding TQQQ?
Well, the guy holding TQQQ starts at 100 too, but on Monday, when the index drops 10%, his triple leveraged fund drops 30%.
Oof.
Yeah, his portfolio is now sitting at 70.
That is a brutal Monday.
And it gets worse. On Tuesday, the index rebounds that 11.1%. TQQQ triples that, giving our investor a massive 33.3% gain.
Which sounds great on paper.
It does, but here is the trap. He is getting a 33.3% gain on his new balance of 70.
Oh man, 33% of 70 is only, what, about 23? So his account goes from 70 up to just 93.
Exactly. The underlying index is back to 100. It broke even. But the TQQQQ investor is still down 7%.
Wow.
And that is just over 2 days of normal market chop. If you extend that math over a year of a volatile sideways market, the daily resetting of the math actively eats your capital alive.
So the volatility drag literally, mathematically prevents the fund from smoothly tracking the long-term upward curve.
Exactly.
The source material used a brilliant analogy for this. It said QQQ is a dependable family sedan and TQQQ is a Formula One car.
I love that analogy.
Right, because QQQ gets you to your destination safely over a long period of time. But TQQQ is this precision instrument built for index day traders. You don't park a Formula One car in your garage, drive to the grocery store once a week, and just expect the engine to last.
No, it will literally tear itself apart. And, the maintenance required for that Formula One car is staggering.
Yeah.
To understand why that maintenance is so expensive and so risky, we have to look under the hood at how TQQQ actually creates that 3 times leverage.
And this was the jaw-dropping fact from the reading for me. Despite the fact that TQQQ's entire existence is tied to tracking the Nasdaq-100, it doesn't own any Apple. It doesn't own Microsoft or NVIDIA or Costco.
None. 0 underlying shares.
Which is crazy,
Yeah.
because regular QQQ goes out and physically buys the shares. But TQQQ is just, what is it even made
The
of?
fund is entirely constructed out of financial derivatives and debt.
The best way I can make sense of it is through a sports betting analogy. Like, buying QQQ is like buying a minority stake in a football team, right? You own a tiny piece of the franchise.
Right. Actual equity.
But buying TQQQ is like going to a bookie, or I guess in this case, a massive global investment bank, and writing up a highly complex betting slip. The slip says, hey, whatever the score is at the end of the day, you pay me triple the point difference, or I pay you. You don't own the team at all. You just own a contract betting on their daily performance.
That is a highly accurate way to describe a total return swap, which is the primary derivative these funds use.
Total return swap. Okay.
Yeah, TQQQ enters into these swap agreements with major banks. The bank agrees to pay the fund a multiple of the index's return, and in exchange, the fund pays the bank a financing rate. It's just a constant daily negotiation of synthetic exposure.
Which totally explains why the fees are so much higher.
Exactly.
The expense ratio for TQQ sits at 0.84%. Compare that to the 0.20% for regular QQQ. You're paying $84 for every $10,000 invested just to cover the massive administrative headache of managing all these swaps.
And honestly, the expense ratio is just the visible tip of the iceberg. The hidden costs are much more corrosive.
Because of the trading.
Right. Because the fund has to hit that exact 3 times target every single day, the portfolio managers are constantly buying and selling these derivative contracts right before the market closes. And this astronomical turnover makes TQQQ incredibly tax inefficient.
Right, because they aren't holding anything long enough to qualify for long-term capital gains.
Precisely. In the U.S., if an ETF generates income from short-term trading and derivatives, those taxable distributions just get passed on to the investor as ordinary income.
So not only are you paying a higher fee, you're potentially getting slammed with a much higher tax bill.
Exactly.
The fees and taxes are frustrating, sure, but the sheer danger of the leverage is what really stands out in the source. There's this real-world example from the text that grounds all this theory in terrifying reality.
Oh, the 2020 crash.
Yeah. During the COVID-19 market crash in March of 2020, the overall market took a massive historic hit. But TQQQ lost over 70% of its value in a matter of weeks.
That is the uncompromising reality of leverage. The golden rule here is that losses are amplified exactly like gains. If the Nasdaq-100 drops 5% in a single trading session, TQQQ drops 15%. Period.
And climbing out of a 70% hole isn't as simple as just getting a 70% gain. Like, if you have $100 and you lose 70%, you're down to $30.
Exactly. The math works against you.
To get from $30 back to your original 100, you don't need a 70% gain. You need a 233% gain just to break even.
It just creates a mathematical crater. And this is why financial professionals classify TQQQ strictly as a trading strategy, not an investment.
Makes sense.
If you're a sophisticated trader who can accurately time a strong, uninterrupted bull run, yeah, it can amplify your gains. But the moment the market turns choppy or bearish, that leverage will wipe out your capital with ruthless efficiency.
So when you realize these funds can evaporate 70% of a portfolio using invisible swap contracts, you really have to wonder, who is letting retail investors tap this button on their phones without a massive warning label?
It's a great question.
Like, how is this perfectly legal for a casual investor to buy?
Well, if we connect this to the bigger picture, the regulatory history here is filled with friction. The SEC first permitted leveraged ETFs to hit the market back in 2006.
Okay, so they've been around a bit.
Yeah, and it was viewed at the time as a natural evolution of financial innovation. But, the tone has shifted dramatically since then.
I can imagine.
Financial analysts, consumer protection advocates, and even senior staff at the SEC have grown deeply concerned about these instruments.
Because the average person downloading a brokerage app doesn't understand volatility drag or total return swaps. They just see 3x returns and a ticker symbol that looks exactly like a famous index.
Right. The investor protection angle is a huge part of it. But there's also a systemic concern that keeps regulators up at night.
Systemic, like for the whole market.
Yeah, think about the daily reset mechanic we discussed. If the market is dropping sharply near the end of the trading day, these massive leveraged funds have to maintain their 3 times ratio. To do that, they often have to sell assets or adjust their swaps into a falling market.
Wait, so they are forced to sell while the market is already crashing, just to keep their math straight.
Yes. And because funds like TQQQ have billions of dollars under management, their forced end-of-day trading can actually magnify major swings in the broader stock market.
Oh, wow. So it creates a feedback loop.
Exactly. It's a scenario where the tail wags the dog, creating market instability during times of high stress.
So not only are you taking on immense personal risk, but the very mechanics of the fund might be making the stock market more fragile for everyone else. That's wild.
Which is why almost any fiduciary or financial planner will issue a stern blanket warning. Retail investors should stay far away from leveraged ETFs.
Leave it to the bros.
Right, they're designed for highly experienced traders who use them for short-term tactical hedging and who are constantly monitoring their screens to exit the position before that volatility drag sets in.
But despite the warnings, the popularity is undeniable. The source points out that TQQQ routinely trades almost 60 million shares a month.
It's massively popular.
There are days where its trading volume literally dwarfs the regular QQQ. People are swarming to the Formula One car.
But the sheer volume reflects the reality of modern algorithmic trading and day trading. Institutions and day traders are moving in and out of TQQQ on an hourly basis to capture intraday momentum.
So the playground for the professionals?
It is a highly liquid playground for professionals. The danger is when a retail investor wanders onto that exact same playground thinking it's a long-term savings account.
So when you look at your portfolio app tomorrow, keep this deep dive in mind. QQQ, the standard fund, is your straightforward play. It physically buys shares in the biggest non-financial tech and growth companies.
Exactly.
It has low fees, high liquidity, and is built for a long-term buy-and-hold strategy. Sure, it carries standard market risk and sector concentration risk, but it's fundamentally an investment. TQQ, on the other hand, is a derivative-fueled betting slip. It resets its math daily, mathematically punishing anyone who holds it during choppy markets, and it amplifies losses just as violently as gains. It is a short-term trading tool.
And understanding that mechanical difference is really the only way to protect your capital. But zooming out, this source material forces us to confront a much broader question about the modern financial system.
What's that?
We live in an era where incredibly complex, derivative-heavy financial instruments are packaged in simple 3- or 4-letter ticker symbols. They sit right next to standard index funds on our screens looking completely identical.
Yeah, literally one letter apart.
So we have to ask ourselves, is the democratization of finance truly empowering us, or is it just disguising institutional-level risk as everyday convenience?
Wow, that is a question worth asking every time you hit buy. Thank you for bringing us such an eye-opening set of sources today. To you listening, keep digging into the why behind the financial tools you use. Always read the fine print, and we'll see you next time.